My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I'm going to demonstrate how to account for installment notes payable. In this example, we are going to once again take XYZ Company, and they are issuing a 3-year $50,000 note with a 5% interest rate, and they are issuing this note on January 1st, 2013. The difference here between the previous examples that we talked about for XYZ Company and this one is that this is an installment note. In this particular case, the lender has specified that payments of interest and principal are due in 3 equal installments each December 31st. So that's what we mean by an installment note payable. The phrase installment note payable means that each payment is going to consist of interest as well as principal. So on January 1st, the first thing that we need to do is to recognize the borrowing of the note. That's relatively straightforward. We simply debit cash and credit notes payable for $50,000. That's exactly what happened. On December 31st, the transaction is going to be a little bit more complicated than we've had with these other types of notes payable, because we have to determine both the interest expense that needs to be recognized as well as how much principal is being repaid. Remember here that this installment note payments are going to consist of interest and principal. So we have to deal with interest expense as well as principal. And so how is it that we go about determining that? Well, the easiest thing to do, or the first thing to do, is to determine what our actual cash payment is going to be. Right? That's not specified here. We need to figure that out. And so I'm going to bring up my financial calculator again, and I'm going to make sure that my time value of money registry is cleared out. Second, clear TVM. And I also need to make sure that my periodic payments, or my periods per year, is equal to 1 again. Remember that with bonds payable, we typically had two periods per year. In installment notes, we could have 1 period per year, we could have 4, just depends on the terms of the note. In this particular case, we're making equal annual payments. Most consumer notes payable would be monthly installments, so our payments per year would be 12. In this particular case, we're just making 1 payment each year. All right, so how do we go about figuring out our cash flows? Remember that this row of buttons here, N, interest rates per year, present value, payment, future value, those are the 5 components that make up future and present value calculations. And with installment notes payable, it's just a matter of identifying which items we know and what is it that we're looking for. Well, what we're looking for is our payment. That's what we have to determine. We know what the present value or the future value of the bond is, or the note, I should say. We know what our interest rate is, and we know how many years this note is going to be outstanding. The question is, what is our periodic payment? And so I know that the present value was $50,000. I brought $50,000 of cash in, so that's a cash inflow. My interest rate per year is 5%, so I put 5% interest rate per year. And this note is going to be outstanding for a total of 3 years, so N is equal to 3. That will then allow me to compute my payment. There is no future value. There's no lump sum payment that's going to take place 3 years from now. It's just 3 equal payments. So compute payment, and that tells me that each year, December 31st, I'm going to be making payments of $18,360. That's the cash outflow each December 31st. Now, the second element here is that I have to separate that cash flow into how much of that goes to interest expense and how much that goes to repayment of principal. Well, first thing I'm going to do is put my payment here in storage. I'm going to store that in memory bank number 1, so I can use it again at some point in the future. All right, so I know that I'm going to be making payments of $18,000 some odd dollars. The question is, how much of that goes to interest? How much of it goes to principal? Easiest approach here is to determine the interest expense. We've talked about this numerous times now. Interest expense is going to be the book value of the note multiplied by the appropriate interest rate multiplied by the portion of the year. We're using the same process over and over and over to determine interest expense. So the book value of the note, so far the only thing that's taken place is the recording of the note initially, $50,000, times 5%, times 12/12ths of a year. The note again was issued on January 1st. It is now December 31st. That's 12 months. So again, technically I would multiply this by 12/12ths, but obviously that's not going to have a mathematical impact on the result. So the interest expense that's associated with this note then is $2,500. I've had the use of $50,000 at a rate of 5% interest for 12 months of the year, and that results in $2,500 of interest expense. So out of my payment of $18,360, $2,500 of that is going to be interest expense. What's left over, the difference between what I'm paying out in the form of cash and what I am assigning to interest expense, is going to be the principal reduction, $15,860. Remember that $18,360 payment, part of it is interest, part of it is principal. And so my journal entry on December 31st is to debit interest expense for $2,500, debit notes payable for $15,860, and then credit cash for the $18,360. So the $18,360 is what I calculated first. That is based on the discounting of the cash flows. So I borrowed $50,000 today. I'm going to be making 3 equal payments at 5% interest rate, and that means that I have $18,360 in cash payments each year. For the first year, for 2013, my interest expense will be $2,500. Book value of the note multiplied by the interest rate multiplied by the portion of the year. What's left over, if I'm making $18,000 in cash payments and $2,500 of that is assigned to interest expense, what's left over is the amount of principal reduction. And so I debit my notes payable for that $15,860. Okay, so that's the journal entries for 2013, or the recognition for 2013. Now what I have to do is deal with my balance sheet. We're going to go into a little bit more depth here. And we need to go into a little bit more depth here for installment notes, because part of the liability, part of the remaining balance of note payable is going to be paid in 2014, and part of it is going to be paid off in 2015. Remember, I've got 2 more payments yet. And so technically, part of the note should be listed as a current liability, the current portion of a long-term note, and then the last part of the note should be listed as a non-current or long-term liability. So how do I go about sorting through that? Well, first of all, let's make sure that we understand what the balance in notes payable is. The balance in notes payable right now is $50,000, that's where it started, minus $15,860. So I know the total balance, or the current balance in my note payable account, is $34,140. That's what I've journalized here, or recognized in the journal entries. So for 2014, or this is as of December 31st, 2013, which is the same as January 1st, 2014. So in 2014, I'm going to make another payment. right? And I already know that that payment amount is $18,360. The question is, how much of that goes to interest expense? Well, we would compute interest expense the exact same way every year. We take the book value of the note, which is now $34,140, and multiply that by 5%, and that tells me that my interest expense for 2014 is going to be $1,707. The difference between interest expense and the cash payment is the amount of my liability reduction. So I subtract 18,360, and that tells me that for 2014, my liability, my note payable, is going to be reduced by $16,653. So out of the current balance in my note payable account, $16,653 will be paid off this year, within 1 year of the balance sheet date. The rest of the balance will be listed as a non-current or long-term liability. I'm not changing the balance of the note payable. I'm just trying to split up how much of it's going to be paid within a year and how much of it is going to be paid more than 1 year from now. And so my journal entry, or not my journal entry, but my balance sheet is going to show the current portion of a long-term note payable of $16,653, and then what's left over is going to be $17,487. That's going to be the long-term portion. The total balance is $34,140. And all I've done here is split up that $34,140 between the current portion and the long-term portion. The way to do that is to determine what part of the note payable is going to be paid in the upcoming year. And that effectively means that I need to do this calculation for 2014. If you can replicate this calculation but for 2014, you will see what your debit to notes payable will be December 31st, 2014. So our transaction, we don't have to record it because we're not at the end of 2014 yet, but our transaction in 2014 will include a debit to notes payable of $16,000 some odd dollars. It will include a debit to interest expense of that $1,707 and a credit to cash of $18,360. The credit to cash is consistent. That's the equal annual installment payment that is required to satisfy the note. What changes from 1 year to the next is how much of that cash flow goes to satisfy interest expense and how much of that goes to satisfy or reduce the liability. At the end of 2015, we'll have another transaction where we will record our interest expense, and we'll also have a cash outflow of $18,360, and the last debit to notes payable would be for $17,487. So in 2013, we recognized $15,860 reduction in liability. In 2014, we'll recognize another $16,653 reduction in liability. And then in 2015, our last payment, we would recognize another $17,487 reduction in liability, and that adds up to exactly $50,000, the amount of principal that we borrowed in the first place. And so we know that at the end of 2015, our note payable will have a zero balance. We will have made all three payments. The note payable will have a zero balance. Just coming back to 2013, to sort of close things out, the income statement will have an interest expense of $2,500. That was our debit to interest expense for the year. So that is the details and a fairly complete example of how to account for an installment note payable. The key really is to understand that you will need to be determining or computing what our cash payment is going to be. And that's a function of the present value of the note, the interest rate, the term, and how many payments we are going to be making.